Good morning, everybody, and welcome back to Schwab Coaching for the Tuesday edition of Trader Talk in today's market. I am your host, Kevin Horner. A much nicer morning here in Denver, Colorado than the previous couple, but I am pleased to be here with all of you on this election day. I want to thank you all for joining me. I see a lot of familiar faces and names in the chat already, one of which, of course, is my friend and fellow coach, Connie Hill. Please say hi to Connie. She's going to keep an eye on the posts in there that I'm unable to get to, but of course I try to do the same and bring your comments and questions into the chat and discussion as best I can throughout. So feel free to post in there, everybody, for the duration of the show. We do go about 45 minutes in total. Before we get started, I want to remind you to follow Connie and me on X. You can do that for us individually at Connie Hill CS, and I'm at Kevin Horner CS. And of course, if you like today's content, please be sure to hit that thumbs up down below. It helps us out in the YouTube algorithm, gets us out there to the masses on a deeper level. And we would greatly appreciate that as well. Make sure you are subscribed to the Schwab YouTube coaching channel. Now, let's remind you of some important disclosures, and then we'll get into the discussion for the day. This conversation is always informational and educational only. Remember, we do not make recommendations or endorsements of a particular strategy or approach to trading the market. It's important to remember that options also carry a higher level of risk. These are not appropriate for all investors. In order to trade options here at Schwab, you do need to be approved on each account on which you would like to trade options. And then you'll want to familiarize yourself with the characteristics and risks of standardized options prior to any option transaction. We also utilize technical analysis here. We discuss it quite frequently, the strategies employed, the concepts that traders might use in placing their own trades. But remember, technical analysis needs to be considered as a complement to your broader fundamental research, which we believe you're already doing, of course. One other note, by the way, as it relates to options, I have a feeling we're going to get to looking at some options in our example portfolio here today. One important detail that you need to be aware of is that when we are working with options here in a paper money platform, as a seller of options, you're always at risk for early assignment. That is to say, assignment prior to expiration. However, in working with paper money, this will not happen. You will not be assigned prior to expiration. Now, you can be assigned, of course, when holding a paper money transaction through the expiration window, of course, but you will not be assigned early. Now, this is a risk associated with short options in a live account, though, so you do need to be aware of that. It absolutely can happen. All right, now if you are new here, everybody, this is the agenda that we take into Trader Talk each morning. We start with a broad look at the market. We hit up the S&P 500, the NASDAQ 100, and the Russell 2000. We also expand to incorporate other areas of the market like semiconductors and some other groupings, perhaps oil, and perhaps the sectors in the U.S. as well, trying to get a picture of what's happening and where money is moving around. And we will look at things over various timeframes before also looking at some stocks in the news and, of course, our example portfolio. And I hope you all have already put together your plan for the day. Yes, it is election day. I hope you are all exercising your civic duty as well. I have already accomplished it. I'm not wearing my sticker today, but I did complete my process yesterday and handed in ballots. I hope you are all doing the same. All right, everybody, let's get right to it. How about that S&P 500? We have talked about the importance of this 50-day moving average over the last 3 trading sessions, and today it stays as important as it has been. As you can see, we've got 4 days now in the vicinity of that 50-day moving average, which is also pretty close to that round figure number of 5,700. 5,700, and this is kind of important as it relates to the S&P 500. Round figures on the S&P tend to have a little bit more validity for the trader in the shorter term, these day-to-day views of the market as we see here on a daily chart. Now, we talked about the nature of breaking below the 20-day with some serious conviction. We did that on Thursday of last week, and then we just settled at the 50-day moving average. Like I said, we had low there on Thursday, came in at 57.02. The close was 57.05, the same as the 50-day is today. Yesterday's low broke the 50-day got down to 56.96, but held on the closed at 57.12. So from that standpoint, a successful test and hold at this point. Now, as we often say, we as traders can change this time frame and get a little more clarity by just evaluating the short-term window, and that can give you something to look at in intraday bases going forward today. So if we take a peek at the 5-minute bars, we're going to make note of today's action already being we're up here around 57.36. If I zoomed in, I'm going to zoom in just on basically since the breakdown, everybody. So here is the highest level we've traded at, and that was really the gap high right after the breakdown from Wednesday into Thursday. And then our lowest level is down here at 56.96. So this is really the range that is most important in the short run, meaning we simply can trade within this going sideways essentially for today and into tomorrow. But moves that would take you above the white line or below this white line is where we start to get directional insight, right? There's no reason that you have to do anything in between all of this. Are there opportunities for the short-term trader in the S&P 500 potentially here? Absolutely. However, that does not mean that a trader who is less comfortable and wanting to be more long-term in nature or more intermediate term in nature should give consideration to these moves. This is not necessarily an area where a trader is going to have complete and total comfort. Too many variables, volatility expected to be all over the map today and tomorrow and into Thursday. By the way, if you were here yesterday, I think I noted expectation for the FOMC rate decision this week. I think I said it yesterday that we were expecting it tomorrow, Wednesday. It's actually on Thursday, the 7th, that we're going to get that rate decision. But obviously, hopefully on the heels of a determined election, meaning we have an understanding of how we're going to move forward come Thursday. That would sure be nice to have some clean, end, if you will, to the election process. So this is what we're looking at. Essentially, it's about an 85-point range in the S&P here on the short term. Looking at the 5-minute bars, coincident and bringing in these pivot points, as you can see. And right now, everybody, we are pushing through the R1 pivot in the day. We have the potential to see a little bit more enthusiasm here short term. Maybe we could pop from 57.40 up into that next R1 ledge around 57.60. That's a possibility for you short termers. But again, not everybody cares about paying too much attention on this time frame. This is getting really tight. So just kind of maybe we're going to monitor where we've been since the breakdown on Thursday. All right. And there it is on the hourly look, everybody, just to give you kind of an additional peak there. That blue line is a 200-period moving average on an hour-long bar chart or candlestick chart. So you still see the range. Really, this will give you an idea as to what's happening when we actually bust out of that range. So that's what we're looking at here as it relates to the stocks. So how about what's happening in the NDX? We're getting a little bit of more optimism there. We're up about 0.75%, but starting to resemble a successful test. Now, I've got a lot of lines drawn in, so let's eliminate a few of these. I'm not going to clear the drawing set entirely, but let's get rid of my initial Fibonacci move. We'll get rid of my oval here on the big deep open we had in August on the 5th. And we've really done well in the NASDAQ since then. Granted, we have not made new highs in that window of time. So what have we made but a lower high here? So the NASDAQ not giving us the strength that the S&P 500 is, as we've discussed a number of times in this show. That is due to the likely due to the makeup or the component breakdown of the S&P 500 relative to the NDX. Heavy on tech in the NDX, whereas the S&P has those defensive groups that the NASDAQ 100 does not. So there's been some support or buoying, if you will, via those defensive groups in the S&P. That's what allowed the S&P to make new highs. Now here, the level to which we have fallen again, coincident with an area of support. Now I've got new ledges down below as potential spots where traders might start to back off of positions in the NASDAQ 100 for those traders looking to move on from positions piecemeal, that is to say, selling a little at a time as weakness comes into the NASDAQ 100. Now, that's what these lanes are. These levels down below have been denoted for, based on the conversation that Jeff and I had yesterday. However, if I take this line, I'm going to activate it. I'm going to bring it over to where this ledge was. So this was a resistance for us. And then it was also resistance back here in the middle, right? So this level on the NASDAQ has acted as both support and resistance a couple of different times, right? And if you take a note of that, coincident with that 50-day moving average, it's kind of nice to see us getting a bounce right here. Now, we haven't done anything to denote a shift in trend. We have to make note of the fact that this is a lower high, a high that is made lower than the last one, right? We have not legitimately broken out, and that's what we ultimately would like to see, is to push through 20,700 or so, and that's going to give us a belief that there's more upside here in the NASDAQ. But new dollars, new money that could be deployed to the NASDAQ 100 here can be done at this time based on an exit strategy that might move you on from the trade on any closes below the 50-day. So what we're looking at is a series of higher lows along the way, and having retreated to the zone of the 50-day moving average, shorter term traders can add new dollars here potentially, but utilize exit strategies that would move on from any recently deployed money if you were to get additional weakness. And that could be trading below the 50-day on a close. For some of you, it might be just as simple as trading below the low we've made in the last 4 days here under about 19,900 or so, right? And if you started to see that, well, that's the kind of weakness that could kick new dollars out. And of course, existing dollars could be looking at something similar, right? Because what we've ultimately done here is broken the uptrend, depending on if I caught all of these lows here, right? If I wanted to catch them all, could I draw it like this and suggest that we've broken the uptrend? I could, but ultimately we potentially found horizontal support at this range here, right around 20,000. And so 20,000 was a level that we needed to get through in the first place. Well, we bounced through it, bounced down into it and held, moved through it, made a short-term high, and come back to it again. So this is nothing else can give new traders that comfort that just says, yeah, if I'm wrong, at least my losses on newly deployed money would be limited in nature, right? You would move on quickly, potentially, on closes below the 50-day moving average. Only limited risk. I mean, we're talking about what could be 300 points of risk here on a 20,000 point indice. So 200 points would be 1%, 300 points about 1.5%, right? Not a substantial maneuver, but at least a way to set your risk properly from that standpoint. So a quick look at how this appears on the intraday charts. There's your 5-minute bars. Here we are gapping into or through rather the pivot point here in purple, which is a nice beginning, and then through R1. We'll see if that maintains. Of course, the high in here again might be important for us, right? The highest we have traded and the lowest we have traded over the last 4 sessions. Again, can be kind of a hint of potential directionality going forward. So something to monitor there once more. Pamela, so question here on NVIDIA replacing Intel. You know, I'm definitely going to get to some stocks in the news. We addressed the potential there yesterday. We actually talked about that news on the headline there yesterday because that came out late on Friday. In fact, I'll just encourage you to check it out. We talked about that in the portion of stocks in the news in yesterday's segment. One of the things I've done in my archived views here, the archived class segments for Trader Talk on a Monday through Wednesday basis, is I build in the chapters for you so you know where you need to go if you'd like to review that. So just check that out in the archive. I'm not going to have NVIDIA on my list today, unfortunately, But ultimately, we did look at NVIDIA. We did talk about the removal of Intel in favor of NVIDIA and the removal of Dow Incorporated, formerly Dow Chemical, in favor of Sherwin-Williams. So maybe check that one out in the archive. Sorry, I don't have time to get to that today for you, Pamela. All right, so let's take a look. What else here? Okay, well, let's move on from the NASDAQ to the Russell, and then we're going to hit up the semiconductors as well. Still stair-stepping along the way here in the Russell, everybody. We talked a little bit about that stair-step just yesterday, how we continue to make higher lows, right? And so even though you'll notice we've really not gone very far, have we? We've got the clean ledge above us at 2,300. And in the weekly view, I think this is a little more easy to see. But the stair-stepped approach is there. And it kind of resembles in the weekly view a little bit more of this ascending triangle, which from a technical analysis standpoint is considered a continuation pattern, the opportunity existing for the continuation of the existing uptrend. And it would look kind of like this. From this low through these lows, you've got that triangle with the bent, the upward slant. Now, the hiccup to this conversation is the movement in rates, and rates continue to remain a bit elevated. Expectation had been to see rates pulling back, or certainly maintaining the lows we were at when the last Fed decision was made. We were trading at 3.6 on the yield. And since then, we've had a lot of U.S. Treasury selling, which has pushed rates higher, yields higher, and we have broken and maintained the 200-day now, everybody, for about 2 full weeks. Now, we are still in that band of potential resistance here, but we've managed to see the S&P maintain, the NASDAQ maintain. So we have been digesting higher rates here without seeing an absolute bit of pressure on the overall market. Now, could we expect to see more pressure if rates continue to climb? I would think so. So I think it bears watching here. Do we get the reversal from yields, meaning do we start to see buying of U.S. Treasuries at these levels, or do we get more selling of U.S. Treasuries, pushing yields even further? That's where we are right now. So what we're hoping for as it relates to the Russell is yields falling, which should give lift to the small caps. We haven't seen it just yet. The small caps have been, they've just been settled in, really. I mean, that's what we ultimately see here, right? We haven't broken any range just yet. We would love to see a move through the 2,300 level or 2,275 up to 2,300, but we just haven't gotten it. Now, the positive is that we've got those higher lows. So we haven't broken the short-term uptrend working since early August. So that remains positive. The question becomes, is that the proper story, or is that just a story that short-term bulls and the small caps are telling themselves? Remains to be seen, right? Clearly, the 20-day moving average is not providing any true indication of things. Sometimes I will go in and just kick out the moving averages that don't matter. So I might go look at a 50 and 200 alone here because it might give a better picture of clarity. Sometimes you just need to remove some of those details that aren't working. And one of the things you can clearly see is that short-term 20-day, we're not trending immediately. We're in this consolidation, building the triangle, etc. But the 50-day has been held back to September 13 or so. So there has been a little bit of support provided there by it. So we'll keep an eye on the 50-day on the Russell. All right, now let's get to Theo was asking about the 50 and 20 on the semiconductors. Let's look at those. I've got the 50 and the 200. I've got the 50 and the 200 in there. We can add the 20-day back in here momentarily. But I think ultimately what we're seeing here is those two, the 50 and the 200, kind of coming together, right? They're not crossing at this point. However, I think it's safe to suggest that if we saw a breakdown below this uptrend line in the SOX, that we would then see the 50-day shorter term moving average eventually, relatively quickly perhaps, cross the 200-day to the downside, giving the potential bearish or death cross. Now, The important takeaway as it relates to crossovers like this, especially on the 50 and 200, is that they are not imminently telling you anything. Okay. Remember, there are many a trader out there that believe that you go long in a group of investments when the 50-day crosses the 200 to the upside, and others that will say, and then therefore will say the exact opposite of that when the 50 crosses the 200 to the downside, that you start to play a bit more defensively. Now, that's, again, there's a difference between selling everything and playing more defensively, right? Trader can always piece out a little by little, put themselves in a better comfort zone by having more cash on hand. And some traders surely would start to move to a little more cash on closes that made a new short-term low. That would be taking out about 49.15 on the SOX here and trading lower. Could we see the level that we saw earlier, the 42.75, the matching lows? Yeah, absolutely, we could. But this could also be the spot where bulls choose to mount their stand on the SOX. So a very important level. We don't have the crossover just yet, but it is something to keep in mind. Now, unfortunately, I can't look at the ETF you're noting there. We'll have to get to that on Friday. So join us on Friday for ETF Friday, of course. But take a look at the horizontal crosshairs that I've got in there, everybody. Are we picking up prior resistance as well at this level? Yeah, we are. So this is a very clear spot where we would like to see trades above it. Once more, this easily could be an area of support. By the same token, if we traded down through the lows we made on Thursday, we could get a bit more volatility. It could be ugly if that were to occur, because that's not, if we were, and of course, I'm not suggesting we have to go there, but if we were to fall from the 200-day down to the matching lows, that'd be about a 14% sell-off into that space, or 14 to 16, depending on how you draw your line there, I guess. Pay attention to that, everybody. That's significant. That would not be great, right? And this is why a trader might very well play defense on moves that would take you through 4,900 to the downside. Now, that doesn't mean a trader's necessarily going to position that way just now, right? Because you're at a spot that could be considered support. And certainly a trader who starts to get defensive now could just as easily be kicking themselves later in the week for getting defensive now, right? So no, and now granted, I'm going to remind you, the most important thing is your comfort heading forward. So if you find that you're sitting on the 200-day moving average and you are uncomfortable nonetheless, it likely means you've got too many dollars deployed, right? Too much money on the table to give you comfort should things go further lower. And so a trader may very well choose to get defensive, but the challenge is we need to be thinking about these things in advance of them occurring, right? We should have thought, oh, where could we see support come into play? Well, for a lot of traders, it can be that 200-day moving average. Some of you would have said it needs to go a little below the 200-day. Look, the last couple were below it, right? These two here were both below the 200-day. So why would we assume that the 200 has to hold? We wouldn't assume it, but we would try to give ourselves an area where we would maybe maintain or stick with our positions. And this is, again, exactly why evaluating this on a day-to-day basis can be important for the trader who is paying this much attention and trading in this type of window, this window of time specifically. Let's see. Somebody wanted to see the 20-day. Let's add my studies back in there. 20, 50, 200. Yeah, so we are back below the 20, below the 50, but sitting on the ever-important 200-day right there. So a very important ledge for semiconductors right here, everybody. The thing that I'm taking away today, I thought for sure we would see some more volatility. It looks like volatility is waning. This was kind of an expectation to see some volatility. Now it's early. We're only the first 25 minutes into the session. So maybe we get a bounce in volatility at some point today. Certainly headlines could play into this, of course. But right now, it doesn't look like volatility is coming home to roost just yet. Watching the level to which we are trading here, maybe 21 down to about 20 and a half, could be intriguing. but I would expect that any pullback in the S&P could likely result in a little bit of a volatility spike. We'll see how that plays. All right. What else do I have in the notes here? Yeah, you guys are noting some stocks in the news as well that I want to get to. I see some of you maybe took a look and made some trades that got you out of some positions. And yeah, in advance of earnings, I can understand that. Why don't we take a look at one other area? Let's hit up oil real briefly just to see if we've made any adjustment. There was news yesterday about out of OPEC. We're going to delay, and it led to some belief that instead of increasing production, they were delaying the increase in production, and that led to a bit of a spike into resistance. We haven't made a significant move here just yet, but we are at a spot of potential resistance. We are back up above the 20 and the 50-day moving averages there. So with any kind of significant development, for example, we could surely pop through those highs we just created. You notice these tails have gotten into this level right around 72.25. And if we were to trade through there, we could surely see the 77 ledge again and the 200-day moving average. But I'll just remind you, we have seen oil in a downtrend. So obviously, I'm paying attention more than anything to the technical aspects, and I will bring you headline details as it comes available relative to oil. But that's how I monitor oil. Oil is such a headline-driven commodity that we got to keep our ears to the rail on that. It is definitely not my specialty, but I will watch it for you with regard to the technical viewpoint. Pretty important level we're traded at too, though, today on a high, 72.25. So let's keep an eye on that. All right. Quick look at sector action today. Leadership is from IT. Not a real shock because we've got the NASDAQ leading the way there and the semis from an industry standpoint leading the way. This looks a lot like the NASDAQ chart, the technology group. Lower high, broke the uptrend line that was working, found the 50-day moving average, but again, have not changed directionality, have not traded through the high of the breakdown day, have not traded through the low of the breakdown day. It's going to look exactly like the NDX there on a shorter term chart. So that's what likely bears watching as it relates to technology. We are seeing healthcare weak today. Let's just take a peek there. Boy, healthcare really broke down, hasn't it? My goodness, this thing was rocking and rolling for a really solid period here, working against the 50-day moving average. And then when it broke that 50-day back here in October, we got a brief respite, a quick rally back into the 50-day, but one day above the 50-day or 2 days above the 50-day did not hold, and we rolled over to test the 200-day. Now, this is a very important level for healthcare, but it's also a level where traders may very well expect a bounce. Previous highs meeting potential new support, right? Former resistance, potentially new support. We are back at this level here. Got a little bit of a bullish divergence because the low we made last here 5 days ago, you can see the RSI made a low there. And then today with the low at the similar zone, the RSI is slightly higher. Not enthusiastic by any stretch, but if we're talking about just standard support, resistance, that stands out at this point on healthcare. All right, now I noted pre-show we've got some stocks in my example portfolio I want to get to. Let's look at some stocks moving around today. We had a few that were notable on upgrades that I thought we could look at real quick. Let me just bring up my notes here. A couple of upgrade calls. One of them was on eBay. Let's see, there's eBay. All right, so eBay made a pretty good retreat. Now, they announced earnings after the bell last week on the 30th, and that resulted in this gap move lower. But the upgrade call is from Bernstein. Analysts upgrading eBay to outperform. Previously at market perform, unchanged price target of $70 a share. Firm believes that the recent pullback in the shares offers a better entry point for new dollars. eBay is refocused on the categories and the use cases that best appeal to its core audience. And recent product improvements are allowing the marketplace to return to modest gross merchandise growth, which offers some upside to the street numbers of expectations. So there was also a note here that Bernstein believes that this could very well support could support the multiple on margins as earnings compound, along with the opportunity for healthy buybacks in eBay going forward. So if we were to look at the low that we just established as short-term support, that does become a potential spot where a trader might start to build new positioning against downside risk, right? Utilizing something like that low, that lovely candle low, that tail at around 56 may very well be notable. Now, longer term, this chart's going to look a little different, but you can see that this has been a stock in the midst of really working hard to correct a lengthy downtrend that had eliminated a bottoming pattern right through here. And, you know, sometimes everybody, we find charts like this and we try to bring these up when given the chance, but this is a really excellent representation of a lengthy window of time that provided an indication that there might be more happening than just a short-term daily view of things. And you had a huge break, a bull flag over multiple weeks, about a 2-month window where we consolidated in that bull flag, moved higher, another 2 months of consolidation, broke strongly, pulled back to the same zone of support. Here, the green line, this is the 20-week simple moving average, everybody, and that has been by and large held for quite a while on the eBay position. So that just seems kind of notable from a technical standpoint, but an interesting spot for potential entry for new users there, perhaps. All right, see a couple of surveys, a couple of survey links there in the chat. Everybody, if you have an opportunity, always love your feedback here. These feedback surveys come to me directly, and I love hearing from all of you. Try to bring into the mix your ideas and thoughts as well. So please do take the 60 to 90 seconds to provide that detail for me, if you don't mind. In fact, if you just click that link right now, it's going to open a browser window for you on this same browser, and it'll be there ready for you at the conclusion of the show. And you can take that 60 to 90 seconds for me. That'd be great. All right. What else is receiving an upgrade today? We had Norwegian. Let me see if I've got headline on Norwegian for us here. Big move off of a. I don't have a headline. Let me see. All right. So the upgrade is out of Argus, upgrading Norwegian to buy from hold. Price target bumped up from 27 up to 30, or excuse me, Argus maintains the price target at 30. Wells Fargo maintains an equal weight rating on Norwegian and raises their price target to $27 a share. So this has all happened in about the last 3 to 4 days on Norwegian, but today's note was from late yesterday, the upgrade out of Argus. Now, you guys have heard me say this before, and when we get going on a new trend, we have bull flags, and bull flags will often bring new bull flags. So what have we seen here but a series of bull flags? And here, this one was really tight, but we're in the midst of breaking it right now. So, okay, now we know that eventually these bull flags will cease. But one thing that is clear in this chart is that the 20-day moving average has provided really nice support for traders along the way. And if this trend is to continue, that 20-day offers an area where they can move on from the trade if they simply get a close below the 20-day, because the instances in which we've had a close below the 20-day since dating back to August 23rd have been extremely limited, right? We've had, I think, 1 day where we may have closed below it, but 1 day does not break a trend necessarily, right? This is where that so-called Horner rule can come into play for you. Looking for a series of closes, 2 days, 3 days, maybe more below a zone of support to validate a breakdown. Haven't gotten that here on Norwegian. So that seems like a chart that's still working for a lot of traders here. We'll see if that continues to roll. And I'd be remiss if we don't look at that on a weekly and then just pull that back again. What do we move through? Very important area of former resistance, now potential support. We have continued to move higher. Where is another level up here, everybody? Maybe 29 is a zone to which we could pop. That's a possibility. And then there's also highs in the neighborhood of about 32 to 33 up above. But you don't have to guess, right? We can just keep raising our stop orders if you've been participating in something like what you're getting out of Norwegian here. So that's a pretty intriguing look there out of Norwegian on an upgrade today. And I did want to remind you that this is available for you, right, as a watch list. Come to the watch list drop-down menu, and lovers and losers is where we maintain analyst downgrades, analyst upgrades. And then I get a lot of questions about, hey, Kevin, you were talking about charts that you like to discuss and things that you pay attention to. One of the things that can be helpful from the public watch list as well, come to those with new yearly highs and new yearly lows, everybody. You want to see new 52-week lows and 52-week highs? That's what these are. Now, if you get them from the watch list, it's going to give you every stock in the universe of the stock market making new highs or making new lows. But you can also do the exact same thing via the scan tab, for example. Reset the scan and just say, you know what? I want to look for stocks that are in that new highs, new lows. So let me go to public, not personal. So let's see. There we are. New yearly highs, for example. And I want to see that in what about the NASDAQ 100? All right. So we'll go to this public one, NASDAQ 100. But what if I said, let me think about this. I want to see stocks making new yearly highs that are NASDAQ 100 relative, but are not in communications. And I'm not picking on communications. I'm just giving as an example of what to potentially consider for exclusion. So let's just go into communications. And so here what I'm saying is show me all new yearly highs in the NASDAQ 100, but not in the communication space. Oh, I got one. Marvell. All right. So the point being, you don't have to stick to the watch list, right? If you want to create some visual for yourself or a list for yourself, you can do so quite easily utilizing that scan tool and the previously disseminated or available to all of us in the public, these watch lists. All right. How about a look at our monitor portfolio here? Our example portfolio has some positions moving favorably for us. And if we've got time, we'll see about placing a new trade here potentially. So let's look at a couple of charts. The first one I wanted to hit up was that Fox, FOX. We've got a position working. It's up 7%, getting a little bit of a continuation move today. Let's make this chart a little bit easier to read. Well, we've gotten the move we were looking for, everybody. We made a new high, and we may have given ourselves a spot under which we can raise our stop order, right? So we can take that stop, which is down here at about 36.99. I'm just going to click and drag it up into that zone right beneath it, okay? Now, am I getting cute with this one? I'm not. I'm just going to approximately below 39, the gap level. So let's save that. Now, brief discussion. I just pushed that to the gap leg. That's it. And the reason I did that is because we've got a bounce today underway. Doesn't have to hold, but I'm trying to capture some of that move from yesterday's action in Fox. Now, if, if, for example, a trader wanted to be a little bit more wide in their stop approach, they might incorporate the average true range in here, right? You guys have seen me do this a number of times. We put on the ATR down below. We see it's 69 cents currently. And so if the low that we made yesterday and today was at 39.70, you might come beneath this and just go to 39, right? If 39.70 is the low at the gap, and then our ATR is 69 cents, you might come 69 cents below what you deem to be support. And that might allow you to maintain the position a little bit longer because ATR is just the average range the stock has seen over the last 14 trading days. That's the default, at least. You can customize that. But the way that a trader might look at that is say, hey, if it averages 70 cents a day in wiggle room, that gives the trader the belief that they can stick with that stock for that 70 cents of volatility that might be broad market weakness, but not necessarily individual stock weakness. And so some traders want to be sure to incorporate ATR when building their stops. That's just one way to give consideration to that. All right, so there's Fox. Let's see. I know I had another couple of positions that have been working. In fact, one of them is something you all were talking about. Palantir had an earnings announcement yesterday that went pretty well, it would seem. Let's bring this up, and I'll give you the headline on this as well. So I was thinking about making some adjustments here because our stop is way far away. So you'll notice, everybody, we've got a one cancels other bracket on this one, or OCO, right? We bought this. Let's put those on here. I'm going to show you how we got it. Show our trades. So we bought it just about a week and a half ago, right here on the break of this little bull flag. Now, we stuck with it because we built in our stop order. We based it on average true range below the 20-day moving average, and that allowed us to stick with it. True range on this, $1.94. So we had our stop is in right here at 40 even, and our entry was 44 and change, the 20-day, about 41.50, 41.90 or so. And so we put it about $2 below the 200-day moving average. And so far, that allowed us to stick with the trade, right? We didn't get a volatility that took us out. But now that we've had this excellent pop, I think, and I'm guessing you traders would agree with me, this is our opportunity to raise our stop order. So here's the news there on Palantir. We had the stock soaring as they made positive, good results and good forward guidance. In fact, I had my headline in here that I'd managed to have misplaced. But we have a Wedbush price target adjustment, raising it from 45 to 57, maintaining an outperform rating. Deutsche Bank raised their price target to 26 from 21. I'm giving you fair and balanced detail, everybody. Deutsche Bank maintains a sell rating on Palantir. So that seems notable. All right, we are getting some big moves here. Stock is up 21 and change percent. So what about moving this just to the gap level, everybody? I think a lot of traders would be comfy with that. If we wanted to incorporate the $2 ATR, then we would look at the low today at 46.86 and move our stop up to 44.86 approximately. The problem there, it's not really a problem. It would be, let's make it 45. What do you say? Just 45 on the nose, and that would put us right to the prior highs. So does that mean we're at risk? Maybe. The reason, good question here, truth will always prevail. Why not take profit? Here's why. I've got a limit sale order out there, everybody. So I've already bracketed my opportunity. The belief was we could get to my exit at 50, what did I say that is at? 55 even. We could still get there. We've got profit. So yeah, we have options. Great point to bring up here. The further discussion may very well be, do we want, we could put ourselves up to 44.90 here, right? And what have we done? We have raised our stop, and we have basically put ourselves in a break-even point because our entry is at 44.70, and the opportunity exists for us to exit for a slight profit. Now, we can't guarantee it because a stop order triggers and becomes a market order, of course. However, if every trade we entered into was by design, hopefully putting us in position to, worst case scenario, find a break even or just a little bit of profit, boy, that's a good scenario to be in, right? Because then ultimately we are trading with extremely limited downside risk. That's going to give us that opportunity. Yeah, it's possible. Truth, you're absolutely right. It could drop 10% tomorrow, and thus we would be maybe taken out of our position or our profits would erode. This is the question a trader needs to ask themselves. Are you comfy sticking with the trade? Or do you look at this and say, this is an excellent opportunity. Let's sell a little here. Just another way the trader could work with this. You could absolutely sell a portion and then raise the stop on what remains. Maybe what a trader does is sell half today, take profits, push that stop up to the gap low in the hopes of maintaining the 50 shares as long as possible, or maybe even let them get into that 55 limit order, right? A lot of ways to go there. You don't have to go about it the way that I have, of course. This is merely an example, and that's why we call it example trade in our example portfolio. So we've raised the stop. The hope here is there's more upside. We've got an opportunity for it. So let's raise the stop and maintain our exit strategy. If we get taken out at 55 for what would be a 10-point gain, a 20+% move, we'd be ecstatic by that. We're going to roll with that and see how this looks potentially next week. All right, everybody. I'm sorry I don't have more time for you. We are at time, but I want to thank you all for being here and joining the class, and certainly for participating in the chat. Big thanks to my friend Connie here. Thank you so much, Connie. Follow us both on X at Connie Hill CS and at Kevin Horner CS. Certainly keep it right here on the Schwab YouTube coaching channel. Lots more to come from us all day today. A very busy election day, but boy, I got to say, everybody, off the jump, isn't it great to see a lot of green on the screen? Hopefully that continues. I hope you all have a fantastic rest of your Tuesday. Make sure you go out and vote, everybody. Put that sticker on your chest. I look forward to seeing you all again real soon.